Welcome to the Daily Fortune, where we talk about the latest topics about finance and investment. But before that, please don't forget to click the like button, subscribe, and hit the notification bell so you'll know when we upload a new video. Now let's get started. So let me share with you the 4-step Buffett approach that we will be dealing with. Number 1 is we should understand the business. We are capable of understanding, and once we've passed that filter, we must have a business with certain essential features that give it a durable competitive advantage. That's a number 2 approach. And of course, according to him, we'd much rather have management in place with a lot of integrity and talent. And lastly, no matter how wonderful it is, it's not worth an infinite price. So we need to find a price that makes sense and ensures a margin of safety. It's a very simple set of ideas, and the reason our ideas haven't spread faster is that they're so simple. Yes, this 4-step approach is very simple, and that approach never ever changes, regardless of market conditions. So whether this video was titled Buffett's Advice for 2020 or Buffett's Advice for 1984, these 4 investing approaches will always remain the same. But in 2022, there's no doubt we'll have some tricky additional factors to consider with our investments. We're dealing with ridiculously inflated stock markets, high inflation, and the likelihood of interest rate hikes this year as a result of that inflation. So let's go to the most important part of this video. Warren Buffett's advice on these 3 investing challenges in 2022. Let's start with discussing the first problem, overvalued stock markets. How can you invest this year when everything is so expensive? If you're an active investor, chances are we won't have many opportunities to buy undervalued stock within our circle of competence this year. Back in 2019, in Buffett's annual letter to shareholders, he said, "In the years ahead, we hope to move much of our excess liquidity into businesses that Berkshire will permanently own." The immediate prospects for that, however, are not good. Prices are sky high for businesses possessing decent long-term prospects. Warren Buffett is seeking to buy entire companies while we're just getting started, trying to acquire a few shares. But at the end of the day, it's all the same thing. Buffett had a hard time finding somewhere to invest his money in the last year or two. But instead of burning his money on inflated stocks, which is a cardinal sin in investing, the "you shall not buy overvalued stocks." So Buffett just keeps accumulating wealth and calmly waits. Berkshire Hathaway's cash pile has increased from $84.4 billion in the third quarter of 2016 to $149.2 billion in the third quarter of 2021. So it's far from ideal. But keep in mind that you gain money while you wait, not when you buy and sell. Wait for the perfect opportunities to present themselves, and don't be pulled into buying average investments in an overpriced market, since, as Warren Buffett says, you only need a few excellent stocks in your lifetime. Buffett also said that,
but 3 wonderful businesses is more than you need in this life to do very well.
We don't need many investments, so wait until the market offers you one. So that's the bitter truth of active investment in 2022. But there is another investing approach that Buffett commonly advises for most people, and it's passive investing. And in 2022, passive investors who are just dollar cost averaging and engaging in stock market should continue to invest.
The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund and never look at a headline, never think about stocks anymore, just like you would do if you bought a farm. You just buy the farm and let the tenant farmer run it for you. And I pointed out that if you put $10,000 in an index fund that reinvested dividends, and I paused for a moment to let the audience try and guess how much it amounted to, and it would come to $51 million now.
It's not about attempting to buy at the right times for the passive investor. The nature of the dollar cost averaging technique is that you invest over time. So just keep buying market tracking investment at the same periods. And if you do this for decades, you'll earn the market's average in return, which is currently at 8 to 10% every year.
So I would pick a broad index, but I wouldn't toss a chunk in at any one time. I would do it over a period of time, because the very nature of index funds is that you are saying, I think America's business is going to do reasonably well over a long period of time, but I don't know enough to pick the winners, and I don't know enough to pick the winning times. There's nothing wrong with that. I don't know enough to pick the winning times. Occasionally I think I know enough to pick a winner, but not very often. And I certainly can't pick winners by going down through the whole list and saying this is a winner and this isn't, and so on. So the important thing to do, if you have an overall feeling that businesses reasonable place to have your money over a long period of time is to invest over a long period of time and not make any bet implicitly by putting a big chunk in at a given time.
So here Buffett was saying to the passive investors that they do not have to worry about the market being high or low. Just keep on going. Don't mind the headline. Don't even look at the chart. Just stick to your approach and the stock market will be your best friend. Even if you invested everything and the market crashed 50% tomorrow, it's still not a disaster for long-term passive investors because it only took 5.5 years to get back to where you were after the GFC, which was the world's worst financial crisis since the Great Depression. And after 9 years on the market, it has nearly tripled in value. Truly, the market is high right now, but it doesn't mean it's the end of the world. Just as I showed you on how to invest in 2022. For active investors, you should stay patient at all times and avoid making foolish decisions. And for passive investors, you should continue to invest as you have had done in the past. Keep shooting for that average. Here's the number 2 challenge, and we all know this word. Yes, it's inflation. Over the past 12 months, it's been such a big story. So in the US, we're up to 6.8% annual inflation. And this year, 2022, looks like it's going to be an even bigger story.
It's a fascinating time. We've never really seen what shoveling money in on the basis that we're doing it on a fiscal basis while following a monetary policy of something close to zero interest rates. And it is enormously pleasant. But in economics, there's one thing always to remember. You can never do one thing. You always have to say, and then what?
Buffett said in economics, there is this one particular thing that we should always remember, and that is you simply can't do one thing. You have to ask, what do you know? Zero interest rates and money printing have finally caught up to us. So what do we do about it? Well, we're going back to 1982. When the US inflation was just starting to drop down after reaching over 20%, and Buffett stated in his annual letter to shareholders exactly what kinds of businesses we should be buying during the inflationary periods, he said, and I quote, "Such favored business must have 2 characteristics. 1, an ability to increase prices rather easily, even when product demand is flat and capacity is not fully utilized without fear of significant loss of either market share or unit volume. And 2, an ability to accommodate large dollar volume in business, often produced more by inflation than real growth with only minor additional investment of capital." So he's talking about businesses that have the ability to raise prices without repercussions, which helps to counteract the effects of inflation. But what business could raise prices significantly without losing market share? People will surely look for cheaper products anywhere. Well, not if you have a moat or a competitive advantage. When Apple raises its prices above the competition, it has no effect on its market share. When Coca-Cola raises its prices, people don't switch to other drinks. And coincidentally, they're 2 of Warren Buffett's biggest investments right now. The most important thing to do during the inflation period is to make sure the companies you're looking for have a competitive advantage. Customers keep purchasing those products even when the prices were increased. Basically, companies that can earn a lot more income without having to spend a lot of money to do so. So in other words, we should look for scalable businesses. For example, Facebook doesn't need to create a new app just to increase ad income. They can simply increase the frequency of their advertisements. Whereas if Ford wants to double its revenue, it must build new factories or hire more employees to produce more cars, which is a much more difficult task. So look for that competitive advantage in times of inflation, as well as companies that are easily scalable. Here's the 3rd and last challenge in investing: interest rate hikes.
Interest rates, basically are to the value of assets what gravity is to matter, essentially. And on Thursday, the U.S. Treasury sold some 4-week notes, Treasury bills, and it says average price 100.000000, 6 zeros. The Treasury received the money at 0. So you've had this incredible reduction in the so-called super risk-free group, the short-term Treasury bill. And that is the yardstick against which other values are measured. I mean, if I could reduce gravity's pull by about 80%, I'd be in the Tokyo Olympics jumping and essentially
if interest rates were 10%, valuations are much different. So you've had this incredible change in the valuation of everything that produces money, because the risk-free rate produces really short enough right now, nothing.
The lower the gravity, the easier it is to jump, but the higher the gravity, obviously the heavier you are, hence harder to jump. The same is true in the stock market. Right now we're experiencing super low interest rates, which implies stock market values can easily climb. There's a lot of money flowing into the market right now, but interest rates are about to start rising in 2022. And the higher interest rates rise, the stronger gravity pulls on the market, making it harder to jump. So you should never let the macroeconomic environment influence your own personal investing. It's worth mentioning that when new bonds become more appealing and interest rates rise in 2022, 2023, and beyond, values may come under pressure, practically overvalued stocks. Be aware that it is possible in the next years, so be prepared. And that's it, Warren Buffett's advice that will hopefully help us with the investing challenges of 2022. So that's it for today. I hope you learned something from today's video, and to get updated with the next videos, don't forget to hit the notification bell. See you next time.